Good morning. It's Jeffrey Christian of CPM Group. It's about 11:40 in the morning on Friday, the 27th of June here in New York. I want to talk about gold and silver and platinum and palladium, and then run through some of the recently released economic data on the United States. Gold prices have been falling. They've fallen about another $68, $70 today. They've gone down to $3,279 a little while ago as I was preparing this presentation. We see that, the gold price just a couple weeks ago was around 3,450. I'll show you the silver prices in a second. It's beginning to look as though our expectation at the beginning of the year. At the beginning of the year, we said we thought that the gold price and the silver prices would rise sharply into the second quarter, but then get into this sort of period of weakness, not necessarily sharply declining prices, but consolidation, to be followed by higher prices later. And the rationale for that expectation was a combination of what we thought would be an initial period of very hostile economic and political conditions, mostly political, in the first part of the year, followed by a period where financial markets sort of capitulated to the state of the world politically and economically, followed by, in the final third of the year, a more hostile economic and political environment as the reality of what's going on in the United States and on a global basis sinks into financial market participants and gets worse. As the year progressed and we saw the strength pick up sharply in April and with prices stay relatively high in May, we thought, okay, well, maybe that middle period of time where you see the prices stop rising and maybe soften a bit could not occur this year given the state of the world. It's now looking in the last couple of weeks as if that initial expectation of a summer lull may in fact be emerging. Coupled with the economic and fundamental environment that I just described, you also had issue of seasonality, where you see precious metal prices, gold and silver prices, typically strong in the first 2 to 4 months of the year. Then they soften during the period May, June, July, August, and then they start rising again toward the end of the year. So there's some seasonality, which reflects the ebb and flow of industrial demand, as well as patterns in investor demand for the metals, these two metals, as well as current economic and political conditions. So the bottom line is we have seen the gold price come off. We have been saying that we thought that the price might find support around 3,200. But to be honest, you could go back to 3,000 or even 2,900 and still be in a pretty strong position. Our expectation still is that 3,200 is perhaps, it's definitely the near-term base that people are looking at, and it may well hold over the course of July and August. We have to see what the state of the world is and the state of the United States, and I'll talk about the U.S. economy later in the day. So that's sort of where we are. We're headed into the summer doldrums, if you will, and it's there. Silver prices are still heading toward July. The first delivery for the July contract is next week. Most of the July contracts have now been rolled. We saw an enormous roll of a couple 100 million ounces over the last 3 days. And as a result, as of yesterday, the open interest in the July contract was down to 123 million ounces. You had 575 million ounces that had been rolled into the Comex September contract, futures contracts. So the bulk of the roll is now behind us, and the bulk of the price strength is probably behind us as well. 123 million ounces is large, but it's probably not enough to really drive the price sharply higher. And again, remember, if you do see the deliveries, and we think you will see deliveries, those are deliveries of warehouse receipts. And most of the groups that take those deliveries leave the metal in those inventories. Generally speaking, you don't see a lot of open deliveries being taken out of the market. If you go back to May, when you had about 82 million ounces of deliveries into the May contract, almost none of that metal really disappeared from the market. It's still there. And in fact, Comex inventories reported and registered are now higher than they were back before those 82 million ounces were delivered. The price of silver has fallen. It got down to about $36.27 this morning, off about 65 cents. It's down from over $37 2 weeks ago. Our view is that $34, maybe $32 are near-term bases for the price if we do go into the summer lull and seasonal weakness. But we really have to wait to see how the political environment shakes out. Looking at platinum. Platinum prices and palladium prices have risen very sharply. Platinum, which has been in this trading range of, say, 850 to 1,050, 1,100 for a decade. It's had a couple spikes up in 2001 and a little bit earlier, up as high as 1,300. But platinum broke out, and it broke out. It's very important to understand. It broke out in June. There's been a lot of talk about the bullishness and the bullish outlook for platinum and how prices are up 44% since the beginning of the year. But about 33%, I think it's actually about 55% that prices are up from the beginning of the year because the price had spiked down toward the beginning of January. The bulk of that increase has occurred since June 2nd. So the phenomenon of sharply higher platinum prices is not a 2025 phenomenon. It's a June phenomenon. And I think you have to take that into consideration. On the right-hand side are CPM Group supply-demand surplus deficits for platinum. And you can see that with the exception of 7 years since 1976, when we first started collecting this data, with the exception of 7 years, we've had surplus markets. Now, in the 80s, late 80s, early 90s, those surpluses were sucked up by Rustenburg Platinum primarily, which was acting like De Beers and being the buyer or seller of last resort. The market got tighter in the mid-90s, and Rustenburg changed its strategy as well as its name. It changed its name to Anglo Platinum, and it also changed its strategy and stopped being the absorber of excess inventories. We were buying platinum for some clients in the late 1990s, and frankly, we were buying Impala Platinum and other people's platinum from Rustenburg Platinum. In the period 2002 to 2011, you saw a tremendous amount of platinum that was actually purchased by investors. And then you started to see some sales. Several million ounces of that were sold. But once the platinum price fell below 1,600, most of the investors who owned platinum stopped selling it. They hedged their remaining inventories with NYMEX short positions, which they maintained for several years. They got rid of them around 2016, 2018, but they stopped selling. And so they still hold a tremendous amount of platinum. We've had surpluses since the strike in 2000 in South African mining in 2014. We've had surpluses and we continue to have surpluses. If we look at what we saw in the platinum market in June, It was a lot of speculative buying and a lot of bargain hunting buying, mostly by investors, but also by some fabricators. We saw a large surge of platinum into China in April and in May. And as the data of those imports came public, the price rose. The price didn't rise so much in April and May because when the actual purchases were being made and the metal was being shipped to China, the price rose after platinum promoters said, hey, there's a lot of platinum going into China. Maybe it's going into jewelry or something like that. A lot of those purchases appeared to have been pre-tariff purchases, investors and industrial users and perhaps government agencies saying, let's bring some platinum in as these threats of trade wars and tariffs emerge, and let's just have it here rather than outside of China in case the trade wars become more virulent. So we'll see what the imports were in June, but the reality is that a lot of those imports didn't seem to be going into platinum jewelry or fabricated products. They seem to be largely investor / speculator and also some industrial companies building inventories and buying for inventories. As a result, our expectation is that the price of platinum will fall back at some point. Does it fall back to the 850, 1050 range that has held for the last 10 years? We're not quite sure. 3 years ago, we thought that the price of platinum would ratchet up into a higher range, but we've moved away from that given structural weaknesses that we see within the physical platinum market, both on the demand, primarily on the demand side. Longer term, 5 years from now, we wouldn't be surprised to see a period of rising prices reflecting tighter supplies. But right now, the platinum market seems to be pretty amply supplied. It's just that the people who own the metal want a higher price for it or a higher lease rate if they're leasing it to folks. So we think that the current sharp increase may actually see prices come off over the course of July and August. And of course, yes, the price was down $60 today. What goes up $350 in a month can come down $350 in a month too. Similarly, palladium prices have broken out of their range. They did, we did see higher prices in 2021, 2022, and earlier. And we did see a spike to $1,250 last October. But the price basically has been trading again largely between $859 on the low end and $1,100 on the high end. Price broke above that over the last couple of weeks, got up as high as about $1,120 or $40 to $50. It's off about $10 today. The chart on the right shows you annual passenger vehicle sales in China. China is the largest auto market now, but half of the light-duty vehicles being sold in China these days are battery electric and don't use platinum, palladium, or rhodium to clean up exhaust because they don't have exhaust. But you're seeing that the auto sales in China and in the United States are modestly stronger in the first 4 months of this year than they had been in the same period last year. Part of that reflects people buying cars in the United States in advance of the expectation that prices would rise sharply due to the tariffs and trade war. That hasn't necessarily happened. I'm going to look at the economy now, and you'll see some of that auto purchases. U.S. GDP, the third and final estimate of GDP for the first quarter was released this week, and it showed a 0.5% decline in gross domestic, real inflation-adjusted gross domestic product in the United States. That was revised downward from about 0.2% in the first two estimates. If you looked at the GDP and you break it down, what you saw was that almost entirely the weaker GDP reflected a surge in imports, which again was pre-tariff inventory building, not in platinum, but across goods and services. So you saw a surge in imports, and imports are a negative to total GDP. It's not gross domestic product in the United States. It's gross domestic product someplace else. If you look at investment, it was strong, which really reflected people just building up nest eggs in the expectation of hostile economic conditions. There were small declines in the in government spending, and there were very low levels of exports. Again, partly because of the rhetoric surrounding the trade wars. And consumer spending was weaker than earlier expectations and estimates had it. So we've seen a quarter of negative growth, 0.5% contraction, and that has to be of concern because expectations are that the economic output will be worse in the second, third, and fourth quarters of this year. So we may be seeing signs, we are seeing signs of a heightened risk of a recession yet this year. Today, personal income and spending data were released. That's important for a variety of reasons, one of which is that the price indices that relate to the personal income and spending are considered by economists at the Fed to be perhaps more accurate indications of real consumer price inflation in the United States. And what we saw was a sharp decline in consumer income in May. There's been a big contraction in the amount of money people are getting. It's not a matter of a slowing down of personal income. It was a reduction of 0.3%, of 3% in personal income. And related to that, you saw consumers pulling back on their spending. So you had some reduction in actual spending. But if you look at that reduction, and you're seeing in this, the news this morning, people were talking about consumers pulling in their horns. If you look at where the changes in consumer spending were, the big bar at the top, in case you can't read it, is motor vehicles and parts, like 49% reduction in May from April. That's because purchases of cars were pushed higher in March and April as people were buying cars in advance of potentially sharply higher auto prices due to tariffs. That happened in March and April. In May, people weren't buying those cars, so you saw this big decline in purchases, consumer spending on the part of cars. The next big decline was in gasoline and heating oil. Again, and that had nothing to do with consumer preferences. It had to do with the fact that petroleum prices fell sharply at that period of time. The third factor, which was only a 10% decline, was food services, eating out, and hotel food services and restaurant activity. And then you can see here, most of the rest of the economy, you did see increased consumer spending. So the reduction in consumer spending in May really was a phenomenon of the auto purchases with some lower petroleum and food prices in. This is the PCE price indices. The PCE price index, the headline industry index is the orange, and the blue line is the price, consumer price expenditures price index, excluding food and energy. And you can see it's been basically largely flat, running in that 2.3 to 2.7 level on a month-to-month basis. So not down where the Fed would like to see it, but not necessarily rising. If, however, you look at it on a quarterly basis, which is one of the things that Fed economists and others do, you can see that we did reach a relatively low level in the third quarter of last year. Inflation, expenditures, these are three different factors. The blue line is the gross domestic product price index. Then the gray line is the PCE, the personal consumption expenditures price index. And the dashed yellow-orange line is the personal consumption expenditure price index excluding food and energy. And you can see they're pretty close to each other. And they all sort of dipped down from the first quarter of 2024 into the third quarter of 2024. They started to rise some in the fourth quarter, and they've risen further in the first quarter of this year. And that's one of the reasons why the Fed is extremely hesitant to lower interest rates. And we happen to think that it's probably correct in its analysis there. That's what I have for now. Have a good weekend. You can go to our website. You can order our gold yearbook and our silver yearbooks for 2025. They've both been released. You can pre-order our platinum group metals yearbook, which will be released in late July. You can subscribe to other services or send us a note at info@cpmgroup.com to talk to us about ways that we can help you more intelligently invest in precious metals and commodities and have a better understanding of what's actually going on in these markets, as opposed to some of the misinformation and disinformation that is broadly circulated. Take care of yourself. Take care of those around you. Try to do something good for the world, and we'll talk to you next week.